Welcome to your Monday pre-market prep show where clarity and purpose meet chaos and the charts. Those charts don't lie, but they definitely exaggerate. I am here to walk you through the fog of financial headlines and shine a light on the news and moves that matter in the upcoming week. This week is all about tariffs, tickers, and tactical timing. The US and China are meeting in Geneva to drink expensive water and maybe, just maybe, reset global trade. Meanwhile, a flood of earnings is going to pour in and we're ready with a mop and bucket. You gotta stay with me because it's not just earnings. We've got geopolitical chess moves in Syria. We've got a select sector showdown, and Trump is back with his tariff bazooka. If you're only half watching, you're going to miss the important setups. The week ahead is like a goat in a tuxedo. Formal, unpredictable, and liable to eat at your margins. First up, we'll take a look at those big players reporting this week. On Thursday, you've got Alibaba, that's BABA, release their full year results. Though most of their sales are domestic, the mood music from Geneva could still impact sentiment on this. Keep your eye on the AI division. 6 quarters of triple-digit growth, but the market is still pricing them like it's 2019. In its sector, GW.com is the weaker of the charts. We'll take a look at those in a moment. It's been unable to hold recent breakouts, while Tencent, it remains resilient thanks to diversified exposure and its gaming moat. First up, it's the valuation comparison. We can see, talking size, price, and perception, Tencent towers above them with its biggest market cap, but its premium valuation shows it's also got the highest price to earnings and the highest price to sales ratio by an absolute mile. BABA, though, trades like it's stuck in 2019, undervalued compared to its peers. And JD, cheapest by every metric, but there's a very good reason for that, which we'll get to in a second. Here we've got some profitability margins. Margins don't lie. Tencent is in a league of its own. 30% plus operating margin, that is serious cash efficiency. Alibaba holds its own, but JD's profitability looks more like a distribution center, wide, flat, and not much sticking. Tencent's margins say luxury tech platform. JD's margins say, I need some volume, I need some just to breathe. And here a third chart showing the performance metrics for each firm. Now let's look at this performance. BABA up nearly 50% this year. That free cash flow shows why. JD barely moving, but again, the chart tells you why, and I'll communicate that shortly. Their earnings may be growing, but free cash flow's thin. Margins are tighter than a London flat. Tencent, steady, not flashy, but that consistency is worth the premium and markets know it. First up, BABA on the weekly time frame. Here, 2 fantastic trades that we've got sketched out. Rocky Outcrop Toolkit doing an awful lot of the analysis for us. Price action held a 382 recently and then continues its ascent. We can see there's a 50 simple about to cross the 200 period moving average. That's a golden cross. I'd pay a lot of attention to that potential area and the evolution of this trade setup. If it breaks through the previous high at 141 and a positive day for earnings, it could reach as high as 190. First area to look for, though, between 155 and 160. That's BABA. JD, on the other hand, significantly weaker. Hasn't managed to hold that breakout, a rejection of the 200 period moving average times 2. And at this point, it's lost the 50 simple. Looks like it potentially will come all the way to a 236. If that happens, there's also the chance of a fair value gap fill at 23 and change, and then the potential again of a double bottom around $20. So I would hold fast on JD, and potentially, if you were looking to long BABA, you'd then consider a short on JD, which would provide you with a sector level hedge. Also then of interest is the stronger performing of the three in this sector to give you a general understanding of trend. Here you can see on the weekly time frame, Tencent holding that 50 simple, putting in higher highs, higher lows in a strong uptrend. So if Tencent's doing well, BABA's earnings are strong, then likely you've got a good trade set up there. If it is that you need to hedge that trade, then the option you might use could be JD.com. So the real detail to pay attention to in that BABA call is the AI division, 6 consecutive quarters of, but we need to be cautious because we know the macroeconomic backdrop for BABA is tight. So we're going to be careful to take caution, make sure price comes to us, pay attention as prices open. We're looking at the ticker BABA. If prices reject that idea of a golden cross on the weekly, we'll see a test of it in the first instance. If prices move to the top side, excellent opportunity for a long trade. Also on Thursday, we get results from Walmart. They're a bellwether for the US consumer. Their conservative forward guidance and the rise in e-commerce sales have painted a very cautious but confident picture. If consumers are pulling back, Walmart are going to show it first. In contrast, Target remain under pressure with margin compression persisting. And there's a very pessimistic sentiment with regards to Target. So if it is that those earnings are negative, then it could be bad for Target also. So you might be looking to hedge that long on Walmart based on an earnings play with a short on Target. Either will provide context to the other. Let's check out some important data points and the charts. The first chart we've made for you here is the valuation comparison. You can see that Walmart wears the heavyweight belt, nearly 800 billion in market cap, and it's priced like a fortress of certainty. Target, that's a bit of a sleeper. It's got 1/4 the book ratio, 1/10 the price to earnings, and it's trading like the market forgot it knows how to make money. Sometimes you have to pay a premium for safety. Other times you're paying for a calm voice in a storm. Let's check out chart 2 and profitability metrics. Here they are. You can see Walmart versus Target. Walmart red, Target blue here. This is where things get interesting. Target does in fact run a tighter ship than Walmart. Better gross margins, stronger profits, and juicier return on equity. Walmart's scale is massive, but when it comes to turning sales into actual shareholder returns, Target is doing more with less. And the numbers here prove it. Performance metrics now. It's a very skinny chart this. Walmart leads on scale. Target shines in EPS and dividend yield. So with revenue, Walmart completely dominates. Net income, no contest, but look at Target's earnings per share. Over 3 times higher, and the dividend yield is almost 5%. This is where value hunters start to salivate. Target isn't just rewarding patience, it's buying loyalty from its shareholders. Walmart's the economy, but Target might just be the trade. So we'll look for that opportunity on the charts. Let me know if you think Target or Walmart is the better long-term opportunity based on these data points and the charts. First up, Walmart and the weekly chart. Here you can see it's touched off the 50 simple, recovered to 236, and it's on the route to the top side again. What is the danger though? This sequel here puts in a touch of bearish divergence. The touch of the 50 simple shows huge bullish continuation divergence. Drop down to the daily time frame, 50 simple above the 200, price action testing an important resistance at 786, a gap close at 102.30, 102.60, perhaps closes up at around 103 for the final push on that degree of price. After this, it's testing the all-time high and potentially into a blue sky breakout. You might be looking for the 1618. That's up at around 123. Getting there will mean it needs to break important psychological levels. Obviously, it needs to go through this inflection point at the top of the gap and through its previous all-time high. And all of that comes in at around $100, a very round number and a psychological barrier. So if there's an important inflection point after earnings, it's going to come in at around 103. If price action can go beyond there, it'll test towards 109. If it can break that, it'll go on and test 120 and change. So that would be a breakout move to the top side. But you've also seen price action did recently test that 50 simple. And so you're looking for an inflection at the prior high in at around $103 to $104. That's where there might be a slight change in the risk profile. Target here on the weekly time frame, a little bit of a channel, not enough touches on the bottom to give it that confirmation. So that might be where it goes if price breaks down. You'd be looking then for in at around $80 on target. But there is more to the story because the RSI has already touched the bottom of the bearish control zone. That offers up the potential for price to rise up a little bit, even if it is just going for a breath of air before sinking again. On the daily time frame, you can see a rocky outcrop flash that comes in at 133.50. It's also in and around where the 200 period moving average is on that daily time frame. The RSI touching the center line now. If it confirms above the center line, target will be pushing back above a 236, above a 50 simple period moving average on the daily time frame, and targeting a rocky outcrop flash sitting on top of the 200 period moving average. And that's a significant trade to the top side. We could take that even tighter, take the entry right on that 236, take the stop right to the very low, and you see you're getting a better than 3-to-1 risk reward ratio. You've got a very good edge if the RSI breaks above the center line on the daily. Down in the 4-hour time frame, you can also see that 200 period moving average in at around 116. That might be where the risk profile changes, so I'd be looking to follow with a stop. And if price action does move to the top side, it'll be closing small time gaps. So target, perhaps offering an inflection point and then a trading opportunity based on the risk reward from that setup and the edge provided by the momentum. Ahead of all of those exciting matchups, on Wednesday, we switch focus to the UK, where Burberry and Imperial Brands both report. Burberry's revival attempt is staring down a luxury sector wibble-wobble, while Richemont, reporting on Friday, is the stronger peer. They've got better momentum, better resilience in those high-end segments. Meanwhile, Imperial, coming in smoking hot, pushing through a no buyback, and a dividend streak that would make a bond jealous. Here again, the important data points. First up, the valuation comparison. This chart makes one thing abundantly clear. Rich isn't just bigger, it's priced for more predictable returns. Despite Burberry's smaller size, it trades at much higher earnings multiples. A whopping 67 times its trailing price to earnings. That's a boutique valuation for a brand fighting to stay front row. Richemont, on the other hand, is priced like a proven performer. The second chart is the profitability comparison, and here you can see that margins are the mirror of operational success. We've got Burberry first in red, Richemont second in blue. Richemont's reflection is slightly cleaner than that of Burberry's. You've got slightly higher gross margin, meaning they sell prestige well, but it's the operating and net margins that show real finesse. Richemont simply turns more of its luxury price tags into bottom line cash. Burberry is working harder to keep up with that pace. Chart 3 now, and you can see the performance metrics here. This is where the scale difference goes from impressive to completely overwhelming. Richemont revenues and net income absolutely dwarf Burberry's. But it's not just about size. EPS, free cash flow, and efficient capital use all tell the same story. Richemont isn't just ahead, it's leagues away in terms of productivity. Burberry's dividend yield is a tiny consolation prize in comparison. So these data points are useful because they show us the valuation, which puts Richemont at larger scale, and relatively modest multiples. We can see the profitability highlights Richemont's efficiency and advantage across all other margins. Performance-wise, we can see that Richemont's stronger revenue and cash generation, while Burberry offer a slightly higher dividend yield in comparison. Here is the Burberry chart, starting again on the weekly. If you're a long-time viewer, I appreciate you. And you might remember that we talked about Burberry back in 2020, 2021. Price action did push to the top side, subsequently collapsed. That was based on an asymmetric marketing opportunity with Burberry selling to China. Tariffs, huge impact on the business. And now we're looking at the return of a potential opportunity based on the high value that the brand holds and the big impact that the macroeconomic headwinds have had on this company. Touching a 236 on the weekly, so risk is definitely on. The previous low wasn't as low on price action, nor was it as low on the momentum indicator, so we don't have a real bullish reversal sign there. We do have horrible continuation divergence on the top side of this resistance, on price action failing to break above an important level there horizontally, and the RSI at extreme heights, which suggests that the effort it took to put price on that retracement was very significant. The move back down again then might not be completely over. The first place to judge that on this 236. That's very important. Dropping down to the daily time frame, and you can see the price action on Burberry already filled in a flash, came back down, tested an 886 retracement. So it could just be that was a piercer move. Now going to test that 236, failing at a death cross with the 50 simple coming through the 200 period moving average. And if price action doesn't manage to get back above that 200 at 841, then it will slip back down and test the previous low in at around 550. If price can break that death cross and start moving to the top side, then it could be testing the prior high at 1,255. That's a very ambitious target from here, and perhaps you'd be looking for 4-hour time frame price action, not going for the rocky outcrop flash quite yet, that interrupted, but instead looking at the 200 period moving average at 900 and thinking if earnings are really positive for Burberry and you bullish on the stock, then 900 be the first place to look for a take profit target. The 50 simple on the 4-hour at the 236 in at 715, and it may well be that early pricing before the market opens, you'd be looking in at around those areas. If you're awake and it applies to you, we'll check in with Burberry later in the show. Richemont on the weekly time frame, and you can see it's in a really strong uptrend. Again, higher highs, higher lows. They're recognizable instantly. This looks like a positive chart. Testing a 200 period moving average, recovering the 50 simple, and now testing this important horizontal where you had 1, 2, and now potentially a third touch. If price breaks this level, it'll also be returning above the center line on the RSI. Bullish continuation potentially. You've also got extreme bullish reversal divergence if you were looking at this retracement back down again, and the opportunity to enter long, recovering the 200 period moving average. Target now 156. If that breaks, you're looking at 163. Price action here could get dangerous if it drops below 128 and importantly 137. So that's a crucial area to look to on Richemont. 137 likely is bought up. I wouldn't want to be holding that trade below 128, though it could be a second entry, and I'd be looking for in at around 119 if all of that breaks down. If that does happen, you'll get confirmation below a 200 period moving average. On the 4-hour time frame, you can see that its price has met an important horizontal level. It's also building up momentum to break through this area, and once it does, it could be a sharp, strong move back above a 200 to 165. If price makes it to 165, it looks like a sound bet that it'll continue on and try for another higher high. German travel titan of tourism, TUI, also reporting on Wednesday. Despite a really strong Q1, bookings have now slowed. Lufthansa, the weakened peer, is facing fuel cost pressures but has seen load factor improvements. So we're going to look to both of those charts so that you've got one potential should earnings go well and a strong bullish move, and then a hedge for the weaker peer that will provide a risk benefit to covering that trade. TUI's margin story is much more nuanced thanks to its hotel and cruise ship experience, offering exposure to other markets and then diversity in periods of tumultuous prices. Earnings season is like a buffet on a boat in a storm. Everything is sliding, but not everything is edible. Let's zoom out now and take a broader look at the US retail sector. Walmart guiding the narrative, but also watch the XRT ETF for signs of broader consumer strength. Let me know if you recognize that ticker, XRT, and why in the comments. If Walmart's e-commerce is outperforming while their foot traffic is slowing, that tells us something about consumer shopping behavior, which also gives us other trading opportunities. In luxury, Burberry are caught in the gears of geopolitics and then typically, as they are, in the fashion cycle. Richemont reports Friday, which could provide a useful comparison. Look to the FX commentary and any data on the Asia-Pacific recovery that greatly overshadowed by that tariff bazooka from Trump. Also, Imperial Brands giving us a little window into the consumer staples sector. Yield hunters have made this their darling as they push into vapor and heated tobacco. That gives them optionality. If traditional sales decline, then its weaker peer, British American Tobacco, has struggled to convince on growth. And in a reduced risk product sector, booming for Imperial Brands and lacking in British American Tobacco, the oil tailwind is real, but so is booking uncertainty. It's been dropping recently. The key here is margin protection and EBIT guidance. So pay attention to those two important factors during the call, and FX guidance in every one of these earnings calls is very important. Select sectors this week are like a clock made of jelly. Technically, they'll tell you the time, but not in any sort of a way that you would trust during surgery. The economic calendar this week is less about volume and more about weight. All eyes are on Geneva, where Trump's team is resetting trade with China. So far, it's a velvet handshake and a spiky hug. No concrete results yet, but the tone is calmer than that discussion we've seen recently about tariffs. Under the radar, a major pipeline deal. But under the radar, and a story nobody else will be talking about this week, but incredibly important for the markets, is a major pipeline deal reshaping regional energy dynamics in Syria. Turkey has agreed to send 6 million cubic meters of natural gas per day to Syria, and electricity flows are probably going to follow. This comes as Qatar funds all of Syria's public wages and Saudi Arabia clears the World Bank debt. That's 3 former adversaries now working in sync in Syria. That matters for oil, that matters for energy firms, and all of that obviously matters for the travel firms. So all of these stories are interconnected and each presents opportunity for the subsequent trade, especially any of those tickers that are exposed to geopolitical risk premiums. Massive opportunity to make money on those minor corrections or those breakout moves. The good old Bank of England recently slashed rates to 4.25%, hinting at policy support amid UK growth concerns. Keep an eye on GBP. Top tip here, it will give a tell on international sentiment, and if it's performing well, then those UK tickers will get an even bigger boost. Any surprise in the CPI or consumer sentiment releases in the US will hit the market at speed. Walmart's results could provide a bit of a softener, a corporate version then of the same themes. Namely, are people still spending money? And if so, macro this week is like a weather report written by the BBC, referencing Scotland. It's like they've never been here. Vague sunshine, scattered chaos, 80% chance that everything they're saying is wrong. Pay attention to the technicals and look for those triggers we talked about. So your personal setup radar, bing. We've got those tickers to watch, a recap of those trades we suggested. Alibaba, that ticker BABA. Watch for a breakout post earnings. The real story for BABA isn't the tariffs. It's whether their AI and cloud division finally moves the needle. A volume spike into earnings would show positioning is live, and that trade has caught the attention of the markets. We also talked about Burberry. That ticker for you is probably BRBY.L. It's an oversold potential bounce candidate. The stock's down 21% year to date. Its earnings aren't catastrophic then. A retracement back up towards 820 could be on, maybe even 900. We also called out Imperial Brands. This is a brilliant potential trade. High conviction setup for income traders. If guidance confirms continued buybacks and a stable EPS, we could see a real test of those recent highs and a breakout beyond them. TUI, TUI, potentially you're looking at TUI1.de. Cautious long bias here. A weak reaction could trigger a dip buying due to those sector tailwinds if oil prices continue to fall. So those deals being signed in the Middle East, reducing the cost of oil, improving the ability for those companies to meet their margin requirements in travel, offering up huge opportunity. If you also put on top of that the FX, then you can see that there might be massive moves in those tickers we've called out today. The story this week, some excellent trade setups then, afterburner on those other data points that come out throughout the week. But that's the point here. The data is coming throughout the week. We have to be cautious of Trump's trade bazooka. We have to be keeping an eye on those talks in Geneva about a potential deal between America and China. And we have to be cautious because some of these trading opportunities only come out to the end of the week, which means that you don't want to be getting yourself taken out of the game too early. Patience pays. But these trades themselves, they're fantastic opportunities. In fact, they're like raccoons with jetpacks. Fast, unpredictable, and likely to completely ruin your picnic if you're not paying attention. Now that we've got those fantastic trades on your radar and you understand the setups, the fundamentals behind the companies, the comparison with their peers, the strongest and weakest in the sector, and we've looked at all of those particular trading setups along with what could give them the afterburner and the boost throughout the week. This section of the show is your chance to get involved. Let me know what tickers you're looking at. Just use the links below or the super chat function if you wish. We're going to jump into your ticker requests. We'll hit them really fast. 60 seconds per chart. I'll respond to live questions. I think worth looking at Under Armour, Cisco. Let's have a little bit of a look at your tickers though. What are you trading this week and what would you like me to take a really quick fire look at? I'll get into that in a minute. Use the super chat function or even better, the links in the description below where YouTube don't take a cut. Get those ticker requests in now and I'll get to them straight away. Chat box in this show, absolutely fantastic. It's like a fruit machine in a monastery. Noise, chaotic, profoundly out of place, but sometimes it pays out big time in wisdom. While we wait for your fantastic requests to filter in, let's take a look at those select sectors. First up, we've got XLE. That's the energy select sector. You can see two huge cavernous gaps on the 4-hour. This top one closed at 93. The one more proximate closed at golden pocket, a 200 period moving average, and $86. So between 82 and 86 is 4. That's 5% price potential movement on this select sector. That'll move if prices move in those tickers we talked about. If oil is going to be dropping, that'll make it so that the energy sector clearly also follows suit. So we're going to pay attention to what happens with a rejection at this important horizontal level, likely a test of a 236 and 78. If that breaks, I wouldn't want to be long. If I do want to go long, that is potentially the best place to go for it. If that breaks and price is looking for support lower, then it's the previous low here in at around 74. Prices will close those gaps on this chart eventually, but up on the daily time frame, you can see that it broke through important levels of horizontal support. Getting back above there is a big ask, and the next level below, you have to go up to the weekly time frame. Just tested that 200 period moving average, so if that breaks now, could be price coming all the way down for a 50% retracement towards 42. That would be absolutely horrendous if you were long oil, so it's important to use those stop losses. That's energy select sector informing you with regards to those other trades, and they themselves giving you greater context over what's happening. Here we have XRT, that famous ticker. Remember, you were going to let me know in the comments below where you first heard about XRT. This select sector is for retail. As you can see, weekly time frame below a 200 period moving average. 50 simple is above that, so it could be worse. But price action finding resistance now at what was previously support and a 200 period moving average on a weekly. On the daily time frame, potential inverted head and shoulders, which could send prices back to 78. That would be a 10% move. If we're seeing strong results from Walmart, that would speak to potential strong moves on the select sector chart here, and you could see this put in that inverted head and shoulders, the measured move that takes it back up towards 80 if it manages to get a positive inflection from the Walmart recall. If it is slowing down before, then the 200 period moving average and a golden pocket comes in at $74. And so I'd be managing risk at that area rather than waiting for the whole 10-15% move on select sector for retail. Very cautious at this particular moment because tariffs could really take the bottom out of this guy. And now we have consumer staples, which has seen really strong rotation into this sector. Here we have higher highs, higher lows, prices holding a 50 simple. Last time it tested the 200 period moving average, strong bullish divergence. Price action only finding a high because it was so overbought. Coming back down now, offering up an excellent opportunity, the 50 simple. That's been offered up twice. Subsequently, price held that RSI at the center line. It's above its own moving average. If it manages to persist in that way on a daily time frame with positive closes, it'll be holding the 50 simple. All of this approximate to its highs here in at around 84. Weekly time frame consumer staples. Huge rotation into this sector, and that's reflected with the higher highs, the higher lows. Last time it touched a 200 period moving average, there was massive bullish reversal divergence. You can see that the only reason price then came up to that horizontal level and paused is because it was so massively overbought at that point. Subsequently, RSI come back down, offer another opportunity to enter at a 50 simple. You've been given that now twice though. So the question is, has the consumer staples select sector found a high? Doesn't seem like it on the weekly time frame. Or what are we going to look at on the daily then to judge whether it's breaking back up, testing those prior highs and going on again, or is it coming back down looking for support at a deeper retracement? A lot of volatility here on the daily time frame. Spread that and put it more in context. Price action finding real resistance at this $82 level, and every time it gets a significant knockdown, it does come all the way down and test 75, and that's a big relative move for this ticker because it's got high volatility. And that's partly due to so much rotation and all of the impact from tariffs. Again, that dark cloud hovering over all of these select sectors, and anything that moves any one of these tickers is clearly going to be moving all of those that compose it. So you're going to see even greater reason to look to the strongest, the weakest, and then your ticker over earnings in any given sector. Sentiment snapshot before we head to that quickfire ticker round. This week, we're cautiously risk on, but make no mistake, the market's optimism is a kite made out of toilet roll. Tariffs are back in the frame and putting that trauma on traders again. Don't position ahead of the headlines. You can't predict them. Nobody can. Even Trump doesn't know what's going to come out of his bazooka next. Walmart and Alibaba are this week's gravity wells. Everything else orbits around them. Pay attention to Walmart, and Alibaba earnings. The Syria Turkey pipeline deal, nobody else is talking about it. Huge significance for the markets. It could reshape commodity flows far beyond the Middle East. I think this is a massive talking point that's been completely missed by all financial outlets. Everything we've covered will be available forever for Discord members and archived for those brilliant YouTube members. I appreciate you. You've had a great treat today in the show. All the charts, all the timestamps from the fantastic Lisa below, all of this value delivered for you. So tell everybody on the Discord, this is where to be. Get on those higher tiers. Make sure you get all the information and really supercharge your progress as a trader with Tradespotting. We have started strong this week. We've taken you up into the air and guided you through some important charts. At this part of the show, where we look at your tickers, we're going to land those trades. We're all going to help each other on the Discord. And remember, trading is all about managing your risk. If you don't have a stop, it could be infinitely bad. If you do have a stop, one day it could be infinitely good. So stick to that risk management. Trading without a stop or trading at all this week is a little bit like flirting with a crocodile. It's thrilling, it's very dangerous, and it's entirely dependent on knowing when to walk away slowly, keeping your eyes on the thing because it could come after you.